Welcome to the deep dive. Look, if you're watching commercial real estate, you know things feel, well, a bit unusual right now. It's November 2025, and that calendar, it's not playing around. Today, we are really tearing into a specific set of sources, curated listings, market intel, all straight from the Eureka Business Group, EBG. They're highlighting some high-value opportunities, mainly, focused on that sizzling Dallas-Fort Worth market.
Yeah, and our mission here is purely tactical, really. We want to be your analytical shortcut. Our job is to pull out those critical nuggets for you. The specific asset details, the hard metrics you can actually verify, and maybe most importantly right now, the deadline strategies you need to think about immediately. Because look, the economy just sent a pretty clear signal.
Yeah, it did. And there's a time crunch forcing people's hands.
Absolutely.
Let's start with that signal then. The Fed. They just cut rates again. Another quarter-point cut just landed this week. Now, this feels encouraging, but let's be a bit critical. Is this repeated cutting? Is it really a sign of opportunity? Or does it maybe hint that the economy isn't quite as strong as we'd hoped? Are investors just rushing off the fence out of maybe fear?
Well, that's the core tension, isn't it? What EBG's intelligence is suggesting, though, is that the immediate psychological effect, it's leaning towards opportunity. The sources are indicating this third cut, this quarter point. It's definitely encouraging investors who were hesitating before to, get off the fence. That money's sitting sidelined. It's suddenly looking for yield again. When borrowing gets cheaper, those fixed income streams, especially the ones backed by really solid leases, they just look a lot more attractive compared to other stuff.
Right. And then that psychological drive just slams right into, well, practical reality. The sources really hammer home this brutal timing constraint. We're talking only about 42 business days left.
Right.
Between now and the end of the year. So if you actually want to underwrite something, get the financing, close a deal, you got to move incredibly fast. Because bankers, as we know, they notoriously slow way down around the holidays.
Oh, absolutely. That clock is ticking loud and clear for potential closings.
Yeah.
And if it's ticking for closings, it is absolutely running out for crucial year-end tax planning.
Exactly. That's a huge one. So for any investor out there who actually bought a commercial property earlier in 2025, maybe even just last month, there's this massive financial planning alert flashing. If you want to really max out your write-offs for this year, 2025, the experts are basically screaming about cost segregation.
Yeah, cost seg. It's a massive tool, but honestly, it's often misunderstood. Cost segregation, it essentially lets you reclassify certain parts of the property's cost. Think things like specialized HVAC, fancy lighting, maybe parking lot improvements. Instead of depreciating them over 39 years with the building, you can classify them as shorter-term assets, 5, 7, or 15 years. This speeds up depreciation like crazy.
Which means bigger paper losses and write-offs this year.
Precisely. Huge paper losses you can use now.
So the trigger is the survey itself then. If you bought property this year and you want those accelerated write-offs, you absolutely must order that professional cost segregation survey before December 31st. If you don't, you lose the chance to apply those benefits to this year's income. I mean, it's a really critical detail, right? It separates the savvy investors from the ones just leaving cash on the table.
It really is. And that speaks to something else. The sources highlight the need for a strong support network. EBG seems to be building that out. Commercial real estate, especially the complex deals, it's really a team sport. You need your CPA, your attorney, that cost seg specialist, maybe a bookkeeper. EBG expanding their network for referrals shows that they get that the retail investor, often needs that whole guidance loop, particularly in a huge market like DFW.
Right. And just to set the stage for you, the listener, EBG, they started back in 2008. They really specialize in guiding retail investors, leaders, franchisees, specifically focusing on this DFW area.
Yeah.
Knowing their niche helps explain why we're seeing such a heavy focus on single-tenant net lease STNL assets in this list we're looking at.
Exactly. Which brings us neatly to the first big investment strategy we pulled from the sources, the appeal of, extreme stability. If you're looking for minimum landlord headaches and maximum security, you look for those corporate and government tenants, especially when they're structured as net lease.
Okay, let's just clarify some jargon there, maybe for the listener. When we say net lease or NNN, what are we really talking about in practical terms? What does that mean for the owner?
We're talking about pretty much the holy grail of passive income. NNN. It stands for triple net. It means the tenant, not you, the landlord, is responsible for the 3 big operating expenses: property taxes, building insurance, and common area maintenance, or CAM. You, the investor, you basically just collect the rent checks. It's pretty clean.
Okay, simple enough. And the sources give us two really phenomenal examples of this passive income stream with, like, bulletproof tenants. Let's start with the Atmos Energy industrial leases. They list two properties here. One's about 3,990 square feet. The other's bigger, 9,790 square feet. Both industrial office spaces.
Yeah, and what's fascinating here is just the sheer track records. Look at the smaller one, for example. It recently renewed for a full 10 years. That secures occupancy all the way through 2035. And this is after they'd already been in the space for 20 continuous years. Plus, it's a corporate lease by Atmos Energy, huge utility company listed on the NYSE, and crucially, holds an S&P A rating.
Okay, hang on. Let's pause on that A rating. For someone buying the building, not the stock, what does that A- really signify?
It signifies serious financial health, investment-grade health. This isn't, some mom-and-pop shop or a risky startup we're talking about. It means that utility giant, Atmos, has an exceptional capacity to meet its financial commitments, like paying rent. You're essentially buying a cash flow stream backed by one of the most financially stable players in the energy sector.
Wow.
Plus, that smaller lease, it includes 3% annual rent increases baked right in, so your income is guaranteed to keep pace with, or probably even beat, inflation over time.
And that combination, the A-rated tenant and zero landlord responsibilities, that's pretty much the dream for a passive investor, right?
Absolutely. And when we say zero landlord responsibilities, that's not just like fancy legal talk. It means the tenant handles the roof, the structure, all the maintenance. You are not getting a call at 2 a.m. because a toilet backed up or the HVAC conked out. That's their problem. The larger 9,790 square foot property, similar setup, also nearly 20 years of occupancy. It's reliable, long-term, utility-grade income.
Okay, so Atmos gives you that utility stability. Then the federal government listing, I mean, that sounds like the ultimate security blanket. The sources detail a 10,375 square foot facility.
Yeah, this one's backed by the U.S. federal government itself. It's via a new 15-year GSA lease, firm all the way through 2034. The building was actually purpose-built for them back in 2006 and then renovated just recently, in 2022, specifically for the Social Security Administration, the SSA. Just think about that. The closest you can probably get to printing money without actually owning a printing press. It might be owning a building where the SSA is locked in to pay rent for 15 years. You just cannot get better credit quality than the U.S. government backing that lease.
Okay, unbeatable stability there. So that's the fixed income strategy covered. Now let's pivot to high-performing retail. Retail can offer higher particular yield, maybe, but it seems like it relies much more heavily on two key things: location, 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 and the specific structure of that tenant guarantee.
Exactly. And we really need to contrast the security levels you see across these different retail listings, specifically differentiating between, say, a franchise model and a full corporate model. This is where the risk assessment gets a bit more nuanced.
Okay, let's take the franchise model first. We see a listing here, 3,070 square feet, STNL retail. It's got a brand new 20-year NNN lease. It's backed by a 19-unit franchise operator. Good location, prime corridor near I-35. Sounds okay, but how does that 19-unit guarantee really stack up against, say, a big Fortune 500 company?
Well, it's really apples and oranges, isn't it? A 19-unit franchise guarantee means you're ultimately relying on the personal balance sheet or maybe the regional balance sheet of that specific operator. If that operator runs into financial trouble across their whole portfolio of 19 stores, well, your store is potentially at risk. Now, you compare that to the next one, the 3,240 square foot listing. It's backed by an experienced regional guarantor, maybe slightly better scale, but still, it's not the same deep pocket security as a massive corporate guarantee.
Right, which is why this under $2 million spotlight asset seems really compelling. So 2,540 square foot STNL retail listing a corporate Starbucks. And it looks like it offers the best of both worlds. That rock-solid corporate backing and some phenomenal location metrics.
It really does. You've got a brand new 10-year lease, and it comes with a full corporate Starbucks guarantee. You can't get much better than that in quick service retail. Location-wise, it's on a hard corner, Route 66 near I-44, which is strong, but the really critical metric here is the traffic count. Over 69,000 vehicles per day, VPD. That is just massive exposure.
Okay, 69,000 VPD. So for the listener, why is that number so incredibly vital for a retail spot like Starbucks?
Because that traffic count translates pretty directly into potential sales volume, and high sales volume translates directly into tenant stability. A corporation like Starbucks isn't going to just walk away from a location that's clearly pulling in massive customer traffic and revenue, and this seems backed up by the explicit financial metric they provide right in the sources, a 6.5% cap rate.
Ah, the cap rate.
Yeah, that's your initial annualized return on investment. And for a corporately guaranteed asset, brand new lease in a super high traffic urban corridor, getting that specific 6.5% number makes the deal very, very clear for investor.
Okay, that clarity is key. And the power of density and performance seems to continue as we look at the larger assets too. There's a 7,000 square foot STNL medical center. It's an emergency facility built back in 2015. It's got 11 years still remaining on an absolute NNN lease.
Yeah, and here, the stability comes less from traffic counts and more from population necessity. It's situated in a really high-density spot in the Arlington corridor. The sources mention over 200,000 residents within just a 5-mile radius. Medical facilities like that, especially emergency centers, they're pretty recession-resistant. They thrive on that kind of density. They aren't likely going anywhere.
Makes sense? And then you get to the real retail behemoths, the $5 million plus opportunities. There's a 37,000 square foot STNL retail property, pretty new, built in 2022. This one sounds like an incredible example of a prime asset. Apparently, it is the #1 LA Fitness in the entire DFW Metroplex based on foot traffic.
Yeah.
Over 400,000 annual visits.
400,000 visits a year. I mean, that facility isn't just serving a local neighborhood. It's clearly a major regional draw. And it ticks all the boxes, carries that corporate guarantee from LA Fitness, benefits from what they say is a below-market rent structure, which adds upside, and look at the location. It's strategically placed right at the intersection of Highway 380 and FM 423, and it's directly across from huge retail anchors, H-E-B, Walmart, Kroger, Costco. That intense co-tenancy basically makes it impossible for that gym to fail due to lack of visibility or traffic.
Okay, so we've covered that passive income angle, the stability plays. But EBG's list isn't just for the landlord who wants to sit back and collect rent checks, right? It looks like there are also some significant opportunities here for the investor who's maybe more focused on appreciation, on leveraging potential, maybe even development.
Yeah, this requires a totally different mindset, doesn't it? It's less about the immediate current yield and much more about building future value down the road. We see this starting with that 8,014 square foot retail center. It's listed in that mid-range price bracket.
Right, it's brand new 2024 Class A construction. It's already 100% leased up, has long-term NNN leases with rental increases already baked in. That all sounds solid. But the really compelling story here seems to be the surrounding area, the demographics. It's located in a really high-growth suburb population, up over 57% just since 2010.
Exactly. So you're essentially buying into a rapidly appreciating location. You get the stability that comes with brand new Class A construction, but you also get the tailwinds of just massive population growth behind you. You're locking in today's price, effectively, for what will likely be a much more valuable neighborhood tomorrow.
Okay, interesting angle. Now, shifting gears to pure development potential. There's a 2.20-acre mixed-use lot listed. Mixed-use zoning allows for up to 84 apartments plus retail space. That indicates a pretty significant project scope.
It does, and this is where maybe some of the risk gets mitigated by public policy, by planning. The sources note that the city actively supports redevelopment efforts along this corridor. Knowing the local government actually wants this kind of project to succeed, that's a huge green flag for any developer looking at it.
Yeah, that city support is crucial. And strategically, thinking about the current rate environment we discussed, the listing explicitly notes that owner financing is available. I mean, that speaks directly to potentially solving the capital access problem for a developer who wants to move quickly on this kind of opportunity, maybe before year end.
Good point. Owner financing can be a game changer in timing. And finally, we see the pure land play. A big one. 37.807 acres of residential land listed. This is specifically an asset sale coming from CAHISD, the Cedar Hill Independent School District, and it's being sold via a sealed bid opportunity. So this really targets those home builders, the larger residential developers who are looking for significant scale in the booming DFW market.
Okay, wow. So we've covered a lot of ground, from ultra-stable leases to raw land. What does this all mean for you, the listener, as you're facing down that final, 42-day sprint to the end of the year?
We've definitely seen a clear spectrum of value present in these sources from EBG. Yeah, I think we've established two core investment pathways here, haven't we? First, there's that ultra-stable path, securing those reliable fixed-income replacement vehicles where you have basically zero operational responsibility. Think the Atmos Energy industrial assets or that GSA-backed SSA building, rock solid.
Right. And then second, there's the growth path, leveraging the power of proven retail performance metrics like that corporate Starbucks with its clear 6.5% cap rate, or the number one LA Fitness with its insane 400,000 annual foot traffic count, or even going for those high potential development lots, especially the ones backed by city support and maybe that owner financing option.
And look, understanding the nuances, the specific type of guarantee, corporate versus franchisee, knowing the hard metrics like VPD and cap rate and foot traffic, and then applying those crucial year-end tax strategies like cost segregation, that's really the only way to successfully navigate this kind of market rush against the clock.
Okay, so here's a final provocative thought for you to consider as you digest all this. Given the current climate, with these repeated Fed rate cuts potentially making financing cheaper, which path actually promises the better return, maybe the faster return, or even just the more achievable return by the time New Year's Day rolls around? Is it locking in that long-term fixed income stability offered by an investment-grade tenant like Atmos? Or is it maybe aggressively leveraging potential financing for future development or securing those high-growth retail locations like that top-performing DFW LA Fitness? Something to think about as you face that 42-day decision clock.